Are we headed for a recession? In today's video, we are going to be talking about recent news from the Atlanta Fed that has the updated numbers for GDP growth as negative 2.8%. Now, this is very different than the general consensus, which was around 2% growth. To go from positive 2% to negative 2.8% is a pretty big swing. In today's video, we're going to be talking about what does the terms contraction mean, what do the terms recession mean, and then what does that mean for your portfolio, and how should you be thinking about that as you're watching some of this news come out? And so as a reminder, I've talked about this in other videos, a contraction is a cycle in the economy where GDP starts to go negative, okay? So if the market or the gross domestic product goes down negative 2.8%, some might start using the term in the media as a contraction. That is negative growth numbers. Now again, we've talked about this other term in videos before, but this is the term recession. And the media loves to use this one. It sounds like a huge deal. Many times it is. But a recession, from a technical meaning, is just 2 quarters of negative GDP growth. So 2 consecutive quarters where GDP doesn't go up, it goes down. And if next quarter we're at negative 2.8%, and the following quarter after that is some version of a negative number, by technical definitions, we will be in a recession, and you will hear about it all over the news. Now, I want to talk about these forecasters, because this is important. Let's look at this chart here. This goes to if you see this blue band, right? So there's a blue line in the middle, and then there's this blue band, which is the range of the top 10 and the bottom 10 average forecasts, and this is considered or called the blue chip consensus. So all the analysts are weighing in, and they're all kind of in this range of, hey, we think that the market or the US GDP is going to be between positive 1.5 and positive 2.5. And then it continues along looking just fine until out of nowhere you see this big drop, which is the Atlanta Fed's updated estimate going all the way from positive 2 to negative 2.8, which is a big swing. Why is this important? Well, I think this is important is because this allows us to look at any version of forward-looking charts about consensuses or estimates and realize that no one knows a thing, and we could probably just pay a lot less attention to what all these expert analysts and forecasters think is going to happen in terms of these averages. And this is consistent with GDP forecasts, with interest rate forecasts, and with short-term stock market forecasts. You don't really have to pay attention. They're almost always going to be wrong. And so unless you're doing it for entertainment, I would say ignore it. And so, okay, we've talked about a contraction may be coming, which might lead to a recession. We've talked about not really paying attention to the forecasters because they can't seem to get it right. What does this mean for your portfolio? And we've talked about this in many videos. More than anything, we don't actually know how a recession or a contraction is going to impact your stocks. Many times, the stock market and the cycles of the economy don't move the same way. And so, more than anything, when we talk about owning a diversified portfolio, not owning overpriced assets, it's more important than ever to know what you own and know why you own it. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.